Hey guys, what's happening? Dan Darrow here with another Options in Play video update. Look at this lovely mess of a chart here, the VIX. Nobody cares about it until they care about it, right? So today's video is going to be about the VIX and the VXX. Apologize already in advance if I confuse you with the terms. I'll try to be as clear as possible. The VIX and the VXX. So we're at a really major price point. I talked about this last week. We're at a really major price point here for the VIX and the VIX, and uh, the difference between a small move higher and a small move lower is pretty substantial, at least from a technical point of view, and it's going to mean the difference uh, in whether we get a big leg higher in the VXX or kind of like a collapse back down to levels from last week or 2 weeks ago. So here's the VIX, the actual instrument, uh, and so in last week's options and play video, I talked about hedges, and at the time I mentioned that with the VIX around like 15, that it actually, if you were still looking to hedge, there was still potential because recent moves in the VIX have tended to stall around 19 or 20, right? Really, really clear recent resistance. That's where it's topped out. Basically, April, May, June. There's been a few rallies. They've all kind of stalled underneath 20. And why this is important? Well, it's pretty obvious from the chart, right? If we get above 20, the first clear levels are not until 25, 26, which is another 20 to 30% higher from where we're at the moment. Uh, I don't want to. I don't want to like sit here and say that we could see a repeat of this January February type move, but that's always in the back of your mind. I mean, it's already happened once this year. There is the possibility. It might not be very high, but there is a possibility. But even just on a more moderate scale, right? Like once we get through 19 to 20, which we can see we're trying to work on. I mean, really, like the next clear level is 25 to 26. I mean, that happened. That was a level that we tested a couple times. So that's why this 19 to 20 area is so critical because once if we fail here, you can see. I mean, we tend to retrace rather quick, and that leads. That kind of coincides with market and averages firming up. I mean, the VIX is not a leading indicator. It kind of just mirrors inversely what the market is doing. So uh, VIX, if it fails at 20, it tends to mean a bounce in the market. If it keeps going, it doesn't necessarily mean that the market's going down, but it does mean that you could start to see heavier volume and more kind of like panicky moves, right, as people start to get more nervous. So it's a really, really, really super critical level here on the VIX. Um, Most people can't trade futures, so VIX is out of the equation. That's why most people tend to look at the VXX or the SVXY, UVXY, stuff like that. These leveraged, double leveraged, inverse ETFs that play off the VIX, and for most of the time they're really bad investment. Well, they're horrible investments, but they can be bad trades too, just because just long periods of just no action, and because of the VIX, for instance, the double leveraged. As the VIX stays quiet or starts to creep lower, this thing is going to lose twice as much value just because of the nature of the ETF, how it was designed, the double leverage. But when you get periods of rises in the VIX, then the VIX gets super interesting because it can move so dramatically in such a short window. Um, and I mean, obviously, you could see what it did in February, and right now it's just starting to get through this 100-day, which had been the top, this 100-day resistance. Uh, it hasn't been able to put in a higher high versus the August volatility pop, and So, that kind of comes back to like the double leveraged nature of this. I mean, higher highs are kind of critical here because then that starts to get people interested. I mean, you can see it's been in like a steady. So even with the VIX hitting 19 and 20 consistently since April, you can see just like a steady lower highs, lower lows. So people don't really start to get interested until you see a higher high. And obviously, how the VIX handles 1920 affects what the VXX does at the current prices. Now, when it moved last time in February and January, it went from mid 20s to mid 50s. Even if it doesn't repeat that, which that could have been an outlier, but a more modest move could get this into the 40s. If you get another 20-30% rally in the VIX from here, there's a potential to see like a push into like the 40s. The problem now is that everybody's interested in the implied volatility is surging on the VXX options, right? So we always talk about this. It's basically protection. Nobody wants it until they do, and then everybody jumps in at the same time, and the prices just go crazy. So nobody wants to touch the VIX. Then all of a sudden, everybody wants in. Implied volatility rockets. And the issue you see with the VXX options is that stuff that's way out of the money is going to have a huge premium because of the tail risk, meaning that people are buying protection in case of that black swan, or that basically what it did in January and February is like this 20s to 50s. So you'll see like contracts that are 20 or 30 points out of the money with a huge implied volatility and really like a much higher than you would anticipate premium. And that's why I like call spreads. So if you're looking to trade this, call spreads are the way to go because you can take advantage of those really heightened prices and the way out of the money stuff to kind of offset closer to the money position, right? So you can get something either at the money, maybe slightly out of the money, and then turn it into a spread by selling something way out of the money where the premiums are really super high. Which is, at the moment right now, like there's the November 40 to 50 call spread, which was a roll from a previous spread. But basically, like the logic behind the position is that you want to take advantage of the stuff that's further out of the money just because of like those crazy tail risk premiums. Things are starting to get interesting, right? Earnings haven't got going yet, but they're just about to, and the volatility is really starting to ramp. There's some wide intraday ranges in the averages, which is great because that means that the volatility should be expanding on names that are reporting. So all of this translates to hopefully much bigger moves on earnings, and that's what we want to see. So I hope you guys have a fantastic day of trading. Have a great night, and I will talk to you all in the morning, all right? Have a good one.